Welcome back to the Wall Street Podcast. Today we're doing a deep dive into a recent Goldman Sachs research report. It's titled China IP Retailers and Toy: Debates on Cycles, Sustainability, TAM, and Share Price Catalysts.
That's right. Published July 28, 2025. It really digs into the key market debates around intellectual property, the toy sector specifically. Things like IP popularity cycles, growth sustainability, the total addressable market, TAM, and importantly, share price drivers.
And it includes a specific look at Mart's long-term growth potential too, doesn't it?
Yes, a focused scenario analysis.
Okay, so let's unpack these core debates for you. First up, the longevity of a single IP's popularity. People often think these things burn out fast.
Yeah, the common view is maybe 2-3 years. But what's interesting is the report highlights ways to break that cycle. If you build a whole IP platform with ongoing content, serialization, think Bandai's Gundam, or even K-pop structures like Hybe.
So continuous engagement.
Exactly. That can push popularity out to 5 years, maybe more. It keeps consumers hooked, opens up diverse monetization.
And things like category expansion, short-form video, they play a role too.
Definitely. Short-form video in particular gives a boost even to IPs without traditional content, spreading awareness very quickly.
Right. So moving on then, if popularity can last, what actually drives a company's sustainability in this space? It can't just be one hot character.
No, absolutely not. Sustainability comes from managing a diverse IP portfolio. That leads to smoother earnings. The report identifies 5 crucial aspects here.
Okay.
Varied content formats is one. Then the ability to either develop or acquire strong IPs. You also need, well, enough resources for that development.
Makes sense. Investment is key.
And robust monetization licensing is big here, plus effective customer engagement. You see this with companies like Disney or Bandai. They have this whole ecosystem.
Giving them much greater earnings resilience.
Precisely. Less reliance on any single hit.
Okay, let's talk market size. The report mentions China's IP spending is, quote, underpenetrated compared to North America, Japan. What's the real opportunity there?
It points to significant growth potential. I mean, just the IP toy market in China is around RMB 76 billion. And globally, single IPs like Pokemon can top US $10 billion in GMV. Disney's retail sales are what, US $62 billion?
Huge numbers, so there's plenty of room for Chinese players to grow.
Ample room, yes. Through expanding categories, but also geographically, think about white space markets like the US and Europe.
Got it. And finally, before we get into specifics, how do share prices typically react to these IP cycles? That's critical for investors.
The report lays out 3 scenarios. For fast-growing IPs, the share price inflection point often comes when high-frequency data starts to weaken.
Even if earnings are still strong.
Yes, because market expectations are already baked in, usually very high. For more mature companies, it tends to align more closely with actual earnings downward revisions.
Okay.
But the highly diversified companies, your Disneys, your Bandays, they show more resilience. Their stock isn't as impacted by just one IP's cycle.
And of course, broader market sentiment plays a role too.
A big role. Sometimes it can even overshadow the IP-specific news.
Right. So with that framework, let's zoom in on Mart. They've certainly had an interesting run recently. What fueled their strong upcycle from late 2023?
It was a mix, really. Internally, they optimized product development and successfully expanded into new categories like plush and bricks and pushed effectively into overseas markets.
And externally.
External factors help too. Celebrity endorsements, a growing demand for what you might call emotional value products that are still affordable, and definitely the viral effect from short-form video platforms.
Quite a confluence of factors. Now, Goldman Sachs painted a blue sky scenario for Mart. How ambitious is that? What does it look like?
Very ambitious. The projection sees potential GMV reaching up to RMB 129 billion. That's reported sales of RMB 81 billion long-term, comparable to Lego's current scale.
Wow. What needs to happen for that?
Well, several big things. Labubu, one of their key IPs, would need to become truly global. The company would have to expand way beyond just toys into many other categories.
And market share gains.
Significant ones, yes. Across China, North America, Europe, and Southeast Asia. It's a substantial long-term vision.
Okay. Considering all these dynamics, the cycles, sustainability, market size, share price reactions, what's the key takeaway for you, our listeners, when evaluating these IP-driven companies?
I think the main point is this. Single IP cycles are, well, almost inevitable. So the real differentiator is the ability to build and manage a broad, diversified portfolio. That, plus expanding into different product types and geographies, that's what underpins sustained growth, and more resilient share performance.
And don't forget market sentiment and those new media platforms.
Exactly. They're critical pieces of the puzzle for understanding share price movements, sometimes even more than just looking at the earnings report.
So understanding these IP life cycles and market dynamics is clearly crucial. This report really sheds light on how companies like Mart are trying to navigate it all. It highlights that the long game isn't just about the next hit toy, is it? It's about building that whole ecosystem.
That's the core idea.
So maybe the thought to leave you with is, next time you see a character explode in popularity, ask yourself, is this just a flash in the pan or the start of something much bigger, much more strategic?